Welcome to our first groups tutorial question. This is a revision question, therefore this question is based on your third year knowledge. Guys, you need to at least obtain 80% for this question. If you do not obtain 80%, you need to go back to basics and you need to study your principles. Now, I've listed a few important elements when you attempt a group question. The first thing is that you need to know your principles. Now, what do I mean with this? If we look at a subsidiary, you need to know what does it mean to consolidate. When we look at an associate, what does it mean to equity account? And with this, it is extremely important that you know how to account for intragroup transactions. Guys, most students fail groups because they do not know their principles and they do not know how to account for intragroup transactions. Then you will identify that I make use of different colors when I work through group questions. This helps me to ensure that I understand the structure, and I make use of a timeline to ensure that I understand the transactions and the flow of my transactions. Then important, I prefer personally to use an analysis of owner's equity. Now, important with your analysis of owner's equity, you need to be able to identify what is the information that you need from the analysis of owner's equity. Guys, there might be instances where it will help you to prepare an analysis of owner's equity. In some cases, it will not help you. Therefore, please do not waste your time. You need to ensure that you plan how you're going to attempt your question, and based on this, you will be able to identify if you need the details of your analysis of owner's equity. Now, on a CTA level, important, in a test, you will receive the information of the scenario and you will have to read through this. Then only after you have read through this, you may read the requirement section. Therefore, we're going to read through the information. You need to use this time to understand your structure, think about your timeline, highlight, and so forth. However, guys, this is not a coloring in competition. Please do not highlight the complete page so that you don't know where what is. Okay, you need to do what works for you. Now, let's read through the info. Ignore value-added taxation in all amounts unless specified differently. The following balances appeared in the trial balances of the individual companies in the Spring Limited Group for the year ended 31 December 2010. Now, immediately we are able to identify that there is a group and they provide us with a separate trial balances of Spring Limited, Rose Limited, Daisy Limited, and Nulana Limited. Now, when you look at the trial balance, you need to identify important things that you need to account for. For example, when we look at this first, retained earnings, balance on 1 January 2010. Then there's a mark-to-market reserve, accumulated depreciation, trade and other payables, revenue, other income. Debits, property, plant and equipment, investments. Now, this is important to us. When we look at this, guys, immediately we are able to identify in the records of Spring that Spring has an investment in Rose, and then in the records of Rose, Rose has an investment in Daisy of 180,000. Then again, when you look at the column of Spring, we are able to identify that there is an investment in Nulana. Other investments, trade and other receivables, inventories, and then ordinary dividends paid on the 31st of December 2010. Therefore, you need to know that this is an intragroup transaction that you need to eliminate. Cost of sales, other expenses, and income tax expense. And then they provide us with the profit for the period. Now, guys, important, you should be able to calculate the profit based on the information above. I've included the profit as this is an easy calculation and you should be able to do this. Additional information. The directors of Spring Limited Group decided to expand the company's operations, and the details of the acquisitions follow here under. Rose. On 1 January 2007, Spring Limited obtained control over Rose Limited. Now, immediately when we identify that there's control, you know that you need to apply your principles of IFRS 10 and IFRS 3. This is a subsidiary, therefore we need to consolidate. By acquiring 166,000 of the ordinary shares of Rose for 210,000 Rand. Now, how many shares does Rose have? When you look at the share capital, Rose 200,000 Rand. Therefore, you're able to calculate this percentage. It's 166,000 divided by the 200,000. 83%. And they indicate to us for 210,000 Rand. Therefore, guys, when you look at your trial balance again, in the column of spring, debits, investments, Rose 210. Therefore, guys, this is still included at cost. However, they do indicate to us that at this point of time that this is the fair value. On that date, the retained earnings of Rose Limited amounted to 40,000 and the mark-to-market reserve relating to other investments amounted to 3,855. There were no other reserves on that date. Therefore, you know you can transfer your retained earnings and your mark-to-market reserve to your at acquisition section. Now, guys, on a timeline, and I have included this to save us some time. This is my structure. Look at the bottom, the timeline. Now, on the timeline, we are able to identify that Spring purchased Rose on 1 January 2007. They've provided us with our retained earnings of 40,000 and our mark-to-market reserve of 3,855. Guys, important when you make use of abbreviations in your calculations. Indicate to your marker what is the meaning of this. I do not recommend that you make use of abbreviations in your journals when you present and disclose. This is not allowed, except for PL, profit and loss, SFP, statement of financial position, and your statement of changes in equity abbreviation. Okay, so when we refer back to the question, guys, let's move on. On the acquisition date of Rose Limited, no unidentified assets, liabilities, or contingent liabilities existed, and the fair value of all assets, liabilities, and contingent liabilities were confirmed to be equal to the carrying amounts thereof. Now, why do they provide us with this section? This is in terms of your IFRS 3 principles. Now, the main principle of IFRS 3 is 1. The consideration paid by the parent to the previous shareholders of the subsidiary should be at fair value. 2. All the identifiable assets and liabilities, therefore they indicate to us, guys, when you read this, there are no unidentified. All the identifiable assets and liabilities included in our group should be at fair value at acquisition date. Therefore, they indicate to us that there is no unidentified assets, liabilities, or contingent liabilities, and the fair value of all the assets, liabilities, and contingent liabilities were confirmed to be equal to the carrying amounts thereof. Number 2, Daisy Limited. Rose Limited acquired 75% of the ordinary share capital in Daisy Limited on 1 January 2010 for 180,000. This acquisition enabled Rose to control Daisy. Important. Subsidiary. You need to know that you need to consolidate. But guys, when we look at our structure, you need to identify that Spring has 83% in Rose, and now Rose owns 75% in Daisy. Therefore, based on this is a vertical group, and we will have to consolidate Daisy into the Spring group. There's an indirect ownership from Spring to Daisy. Then on our timeline, it is important, we need to include when did we purchase Daisy. Now, Daisy was purchased on the 1st of January 2010. At the date of acquisition of Daisy, a portion of land that was stated in the records of Daisy at 322,000 Rand was valued by a sworn appraiser by 10,000 more. Again, guys, back to IFRS 3 principles. All identifiable assets and liabilities should be recognized at fair value at acquisition date. Therefore, we will have to identify that we need to include 10,000 as a fair value adjustment at acquisition date on our analysis of owner's equity. The revaluation was not recorded in the records of Daisy Limited. Why? Because this is a group rule in terms of IFRS 3. This was the only item in the records of Daisy Limited that had a fair value that was not equal to its carrying amount at the date of acquisition. At this date, no unidentified assets, liabilities, or contingent liabilities existed. Nulana Limited. On 1 January 2009, Spring Limited acquired 40% of the issued share capital of Nulana Limited when the retained earnings of Nulana amounted to 20,000 Rand. The cost price of the investment in Nulana Limited amounted to 92,000 Rand. Since that date, Spring Limited has exercised significant influence over the financial and operating policy decisions of Nulana. Immediately, what do you need to identify? That this is an associate. Therefore, you need to apply IAS 28 and you need to equity account. Therefore, guys, on our structure, we need to include that we have purchased Nulana, the associate, on 1 January 2009. And they indicate to us on this date that the retained earnings amounts to 20,000 Rand. Okay, so guys, when you look at our structure, we are now able to identify that Spring has an associate, Nulana, and we need to equity account. Now, what does it mean to equity account? I've included the important principles of equity accounting. Now, when we have to equity account, we need to include the investment on initial recognition at cost. Therefore, they've indicated to us that they've purchased this investment for 92,000. Therefore, debit the investment, credit bank with the amount of 92,000 Rand. Now, it is important that you know that we will not recognize any goodwill should there be. However, if there is a gain on bargain purchase, you need to recognize this journal entry separately. Now, why do we not recognize goodwill? Because the rules of equity accounting indicates to us we need to recognize the investment at cost, and only if there is a gain on bargain purchase, we recognize the gain on bargain purchase. Guys, but we do not recognize any goodwill. Then step number 2, you need to add or deduct any losses or profits. Now guys, there is separate rules in terms of the losses, which we will look at when we look at IAS 28. Number 3, add or deduct your profit or loss and OCI. And then number 4, very important, you need to deduct your dividends. Your dividends will decrease the carrying amount of your investment. Now guys, very, very important. Remember, this is the rules in terms of our group. I'm going to repeat this. It's the rules in terms of our group, not in the separate records of Spring Limited. On the above acquisition dates, there were no unidentified assets, liabilities, or contingent liabilities, and the fair value of all assets, liabilities, and contingent liabilities were confirmed to be equal to the carrying amounts thereof. The following additional information is relevant to the question. Intragroup transactions. Extremely important, you need to know this. A lot of students fail group questions because they don't understand intragroup transactions. During the current year, Rose Limited sold inventories to Spring. Therefore, Rose is the subsidiary and the subsidiary sold to the parent. Now, if the subsidiary sold to the parent, you need to identify immediately that this will have an effect on the analysis of owner's equity of the subsidiary. The following details applied to the intragroup inventory sales. Profit markup of 35% on selling price. Now, what does this mean? Your selling price will represent 100%. Your profit will represent 35%. Total intragroup sales for 2010 amounted to 115,000. Therefore, we need to eliminate this. Inventories on hand on 31 December 2010 of Spring Limited. This is in the records of Spring. Spring is our buyer, which were purchased from Rose, amounted to 45,000 Rand. Now, guys, important, we need to eliminate the unrealized profit that is still included in the inventory amount. And as always, you need to remember your tax. Nulana Limited has purchased all of its inventories from Spring. Now, Spring is the investor and Nulana is our associate. Since 1 January 2009, at a 25% markup on cost price. Now, what does this mean? Your cost will represent 100% and your profit will represent 25%. Therefore, your selling price will represent 125%. Now, when you look at this, they indicate to us all. Therefore, we need to refer to the trial balance and identify what is the value of the inventories in Ulana's records. Now, this is our last column, inventories, and this is 47,000. Now again, guys, identify your steps. You need to eliminate the unrealized profit that is still included in the inventory, and you need to remember your tax. Now, important with this one, it's an associate, therefore you only have to take out the percentage owned. Okay, so guys, when you look at the first intragroup transaction, Rose sells to Spring. Therefore, this is upstream. When you look at the second intragroup transaction, Nulana purchased all of its inventories from Spring Limited. Therefore, this is downstream. Intragroup transaction number 3. On 1 April 2010, Rose Limited sold machinery with a carrying amount of 55,000 Rand to Daisy Limited for 73,000 Rand. Now, guys, remember Rose is the parent of Daisy. Daisy is the subsidiary of rows. Therefore, rows sold to, and this will be downstream. The machinery was acquired on 1 April 2008 by Rose and had an expected useful life of 5 years at the original purchase date, which has remained unchanged. The entity's policy is to provide for depreciation over the expected useful life of machinery using the straight line method, which is consistent with the tax allowance of the South African Revenue Service. Therefore, you can identify that the carrying amount will equal the tax base. There will not be any deferred taxes. Accounting policies. The Spring Limited Group measures its investments in equity instruments at fair value through profit or loss. The fair value of all the equity instruments is equal to the cost thereof unless otherwise stated. Now guys, important to identify when they refer to the Spring Limited Group, what does this actually mean? When you look at our structure, the investments held by Spring Limited, therefore in the separate records of Spring Limited, will be at fair value through profit or loss. The investments held in the separate records of Rose will be at fair value through profit or loss. The investments held in the records of Daisy will be at fair value through profit or loss. Now guys, if we did not have a vertical group but only an horizontal group, they will indicate to us that Spring Limited will keep these investments at fair value through profit or loss. Now they've indicated the word group due to the fact that we have Rose that has an investment in Daisy. Then the Spring Limited Group elected to measure any non-controlling interest in an acquiree at its proportional share. Now guys, at proportional share, what does this mean? Our NCI will not share in any goodwill. Important. If at fair value, you need to remember our NCI will share in goodwill. Then they indicate to us the Spring Limited Group accounts for investments in associates using the equity method. Now this is in the group, not in the separate records of Spring Limited, in the group. Sundry information. On 31 December 2010, the directors of the Spring Limited Group assessed goodwill and found that the goodwill of Rose Limited had been impaired by 2,500 Rand from the time that the investment in Rose Limited was acquired. We need to identify this, guys. We need to decrease our goodwill. The share capital of companies has remained unchanged since 1 January 2007. The normal South African tax rate has remained unchanged at 28%, and capital gains tax is calculated at 80% thereof. Assume that each share carries 1 vote. Now let's look at our requirement. I'm briefly going to read through the requirement with you, then we will work through each of them in detail. A. Calculate the following amounts that will be disclosed in the consolidated statement of financial position of the Spring Limited Group as at 31 December 2010. The investment in associates in terms of IAS 28 equity method and our non-controlling interests. B. Prepare only the assets section of the consolidated statement of financial position of the Spring Limited Group as at 31 December 2010. Ignore any deferred tax, therefore do not include a deferred tax line item. C. Prepare all the intragroup journal entries for the Spring Limited Group as at 31 December 2010. Your answer must comply with IFRS. Notes to the consolidated annual financial statements are not required. Guys, comparative figures are also not required. You do not have information for comparative figures. Round off all amounts to your nearest rand. Now, you need to plan how are you going to attempt this question.